your question about with all the tax changes, has that changed the calculus, I guess, about the choices between being in a partnership and being a corporation, which we get a lot of that question. I mean, it was white hot early on, and we're still getting it quite a bit, folks wondering, is this, should we think about starting out, should we be a corporation, should we be a partnership? A lot of the calculus that goes into that is not as much change as you might think. With the corporate rate drop to 21% across the board, down from 35%, which was the highest rate, but it got to 35 pretty quick. And so for most folks in the rough calculations, it was 35% and now down to 21%. And folks are saying, wow, that's great. Partnerships are taxed as flow-throughs. The highest rate has come down to 37%, but there's a lot of distance between 37 and 21. Of course I should be a corporation, tell me why not. And the reason is because when you're in a corporation, you're still in a corporation, so you're still subject to double tax. And so as long as you're planning to just be in the corporation, not distribute any of the money, which most folks say, well, no, that's not a good idea. Who would do that? That if you just leave it in, sure, you're paying 21% on the income, and everybody's happy, and you've got a lower effective tax rate there. However, once you start distributing the money out, you're going to be subject to about the same tax rate as you are in a partnership. And so it's more competitive than it used to be, but it's still, a lot the same. And so that choice may be made on something other than pure tax rates. And in fact, the partnerships, I think they, as part of the legislative tussle, sort of pushed back a little bit and said, hey, you're helping the corporations out with this huge reduction. The partnerships picked up sort of a 20% deduction on their qualified business income, which is generally sort of what you think of as partnerships operating businesses that do real things, and specifically not partnerships like law firms, accounting firms, people who don't really produce anything. I think they took a few of my architects out, but everyone said, but of course they're still going to be subject to it because of kind of what they do, but that was probably the lobbyist thing. So as long as you're doing a real business, you're still going to get roughly a 20% deduction. There's some limits on that to ensure that you are, or to encourage you to hire people and to buy equipment. And so it's sort of the lesser 20% or 50% of your W-2 wages, or the greater 50% of W-2 wages, I think 25% of W-2 wages, and 2.5% of your unadjusted basis in the profit. Again, if you're going to be, some businesses effectively have to be in a corporation. You got foreign partners, that sort of thing. You're pretty much going to be there. Sometimes historically, and also if you're in a corporation and have been for a while, it may be somewhat painful tax-wise to get out because you're still subject to double tax. And so that can be a pretty heavy hit that comes to you if you're not eligible to convert to an S Corp and get the flow-through taxation that a lot of folks find useful.
So Mike, you mentioned foreign partners, and that's a good segue to Robert, whose Robert's practice is international. And so Robert, looking through the lens of the international aspect, what are you seeing as the biggest impacts on small and medium-sized businesses from the new international tax changes?
Yeah. So we had a very interesting tax season because most of tax reform takes effect in 2018. So it started happening of January 1st of this year. But in the international arena, there was one particular tax called the mandatory repatriation tax or toll tax, where any companies that have foreign subsidiaries and over the years have deferred their foreign profits and not pay tax because they were keeping them overseas, all of those earnings are now mandatory tax in 2017. So retroactive, essentially. I mean, income inclusion right at the end of the year. So we had all of 5 days to prepare for it. So we spent all tax season running those calculations and helping figure out which clients were affected, and so that was a very interesting exercise. With the rules changing as the tax season progressed, the guidance kept coming out, and what we're seeing with tax reform is because it was passed so quickly. It was 50 days from the initial draft to final signed legislation, and frankly, there's a lot of mistakes and a lot of unintended consequences and a lot of things that are drafted in an unclear way. And Congress borrowed a lot of existing definitions and used them in new ways, and then also came up with new definitions that there's no existing guidance on. So we're a lot of times waiting for more word from the IRS, kind of trying to figure out how things work. In the international arena, if you're a corporation, you really benefited a lot, because you not only get a 21% corporate tax rate, you can permanently exempt your foreign income from tax in the future. You had to catch up your tax for earnings from the past at a beneficial tax rate, but going forward, if you meet the rules, you can bring back dividends without paying any U.S. tax. So what is very interesting for our type of clients or middle market businesses is that it really opens up the sphere of international tax planning for legal tax avoidance rather than evasion. But it opens up the tax planning to a scale that middle market businesses have never been able to take advantage of before. Because if you're a middle market business, what do you need to run your business? Cash, right? Cash is king. So if you were in a situation where your foreign subsidiaries could avoid U.S. tax as long as you didn't bring the money back to the U.S., well, that doesn't help you a whole lot, because you'd like to get that cash back in the U.S. to reinvest in your business. Under tax reform, you can now get that cash without incurring additional U.S. tax, which means, like Google and Apple and the big mega corporations who are using tax haven countries and various tax incentives overseas to lower their global effective tax rate, middle market businesses can now start to take advantage of some of those same opportunities. If you can find a tax incentive in your host country that can get you a lower tax rate, you can actually permanently benefit from that. If you can lower your global effective tax rate, you permanently lower your global effective tax rate. So that's a very interesting opportunity. There's also, comparing corporations to individuals, there is a very strong preference under tax reform for international operations to be operated by a U.S. corporation rather than a flow-through entity or an individual, because some of the rules really are punitive to individuals, where normal tax benefits they should be getting are no longer available. They are taxed at extra high tax rates, double taxed, immediately taxed on foreign earnings, even if they don't have the cash to pay it back. So that a lot of the conversations we've had with clients is, first, how do we deal with that repatriation tax for April 15? Second, how do we get you out of your current structure and into a structure that works better for your business? Re-examining the entire structure of our clients' international operations. So it's a busy year.
Gotcha. But if I go from a partnership to a corporation, once I'm there, I'm there. And if I ever want to get out of a corporation or sell the corporation, that's going to cost me, again, that double tax. Even if I say I'm going to hold it forever and I'm not going to take, distributing the money as dividends, it's going to keep plowing, it's going to get huge, but I'm going to keep it forever and ever. And as long as you do that, you may be in good shape. But if you ever think you're going to sell it or find yourself selling it, it could be very, very expensive. And another thought on the comparison between partnerships and corporations is they're roughly equivalent on the tax rates currently. Excuse me, once they brought the corporate rate down to 21%, but no rational person thinks those rates are going any lower, nor do they think those rates are going to stay in place forever. There's a lot of room to move back up to 35% and to say, well, what are you complaining about 35%? That's what it used to be. What are you complaining about? We just moved it to 30%. It used to be 35%. You should be happy that you left it that way. And so planning based on what tax rates are going to be in the future is a sure route to potential disaster because things can come back. And so we haven't seen a lot of folks switching from what they are. Some of them have sort of reconfirmed what it is that they're doing, or they had been considering getting, maybe switching out, or sometimes the facts and the asset basis, those sorts of things, work for them. We haven't had a lot of folks moving. A few of them do because they say this really does make sense for the way we've been operating, such as we've been in a partnership and we would have been plowing all the money back into the partnership, but for the fact we keep having to make distributions for our guys to pay taxes. And they say, if we can go to a corporation, we think it's going to work for us because going from partnership to corporation is generally painless, as long as you're happy once you get there.
So Robert, we've talked about choice of entity, and on the international front, there may be other issues. So what are some of these issues that companies face if they want to grow internationally, and how are your clients adapting to those?
Yeah. So a lot of there's a lot of non-tax issues if you're expanding internationally. So we've got clients who have bought companies. So we've got a software client that bought a company overseas that had some technology that they wanted to utilize and some developers. And so there's cross-cultural issues you run into, even in another English-speaking country like Canada or the UK or Australia. There are cultural differences that you have to understand, appreciate, and learn how to work in another culture. It can be especially sneaky when it's the same language and you don't think there's a cultural difference, but in reality there are some very important but perhaps hidden cultural differences to deal with. Also, just dealing in foreign currencies. We had one client actually acquired a UK company right before they had done the deal and got a price in pounds right before the Brexit vote happened. So suddenly the pound dropped, and then they having to convert from US dollars into pounds hugely benefited. So the timing was fantastic, and then we helped them do some tax planning, and it turned out when tax reform came around, the tax planning we had done around that acquisition also turned out to be perfect for tax reform. So this client is just very, very fortunate. It has a good sense of timing.
Do they want to be a member of the chamber? Paul, can you make sure they got Robert? Apparently they got some cash laying around. So.
But you have to deal with how do you structure that investment from a U.S. tax standpoint. What works well from a foreign tax standpoint, what works well from a U.S. tax standpoint. And so we have software that helps us run some of those calculations. Then we've got an international association of accounting firms that can help fill in the details from that foreign tax perspective, because there's always mismatches. Even within the U.S., there's mismatches between law, from state to federal, from different types of federal law to other types of federal law, and from international, as you can imagine, it just multiplies. There's different kinds of tax systems, there's different types of taxes.
I've seen a lot of mergers and acquisitions activity. Some of that is in reaction to the new tax law directly, which is the law has changed and we want to take advantage of it. But there's also sort of indirect, which is we were waiting for the law to change before we did anything. A lot of folks are going to do something at the end of last year. We're thinking about it, but they really hate to take that step to enter into a transaction if you don't know what the tax law is going to be. Sometimes it can work out well for you, and sometimes it doesn't if you don't see it coming. And they say, I saw it coming, so it'd be sort of foolish to jump in and injure myself by doing a deal at year end. And so a lot of activity at year end sort of was held in abeyance until the tax law gets changed, and then a lot of folks said, this is great, the rates are down, we're better off doing it next year, and we weren't really wanting to spend our Christmas holidays doing deals and having to worry about it. But after the new year started, there were a lot of businesses being sold, which on the other side, a lot of businesses being purchased. Folks who've sort of, I think, been waiting to get out, and they say, lower tax rates, this looks like to be a good time. And there had been sort of an implied, sort of underlying sense that the tax laws may change for several years, and folks were a little bit worried about what might happen, and even estate taxes and that. And so a lot of them, I think, have found, here's my opening, I want to get out now. And so there's a lot of that activity.
So Robert, let's close out the discussion by kind of localizing the discussion. And so one of the hats you wear is one of the tri-chairs of the International Concierge Committee. So are y'all seeing an uptick in interest in U.S. business formation from international companies? And are these tax changes having an impact that you've seen on kind of inbound investment?
Yeah, I think we are seeing an uptick. I think that's partly, to a very great extent, a credit to Mike Skelton and the Richardson Economic Development efforts internationally. Mike is constantly flying all over the world to bring companies to Richardson. He does a really great job. So we're seeing the fruits of that effort. But we're also seeing that in the past, one of the big hurdles to forming a business in the U.S., if you were a non-U.S. person, was tax. Because if you form a corporation, which is the most common form of doing business for international people, you have a 35% tax rate. That's low. That's a higher rate than most of the countries around the world. So if you're from Europe, or even if you're from Japan, a 35% tax rate plus state and local taxes around the country, if you're doing business in multiple states, that's a pretty big hurdle. And then also the estate tax, because the best way to avoid the corporation tax problems was to use a flow-through business. But a flow-through business would expose you to estate tax. As American, as U.S. citizens and residents, we're kind of fortunate that we had a $5.5 million estate tax exemption, and now it's an $11 million estate tax exemption for the next 8 years. So if we croak, we got to have some pretty good money to have to worry about the tax man.
You gotta have Paul Volcker method.
There's some.
But if you're a foreigner, the grand total of your exemption has remained the same since 1976, $60,000. So if you have any U.S. assets that are worth more than $60,000, which is not hard to do, if you buy a house even anywhere in the Dallas Metroplex, you're going to be very hard pressed to find a house for less than $60,000 now. So if you pass away, all of your assets are going to be subject to estate tax in the U.S. The best way to avoid that is to use a corporation structure. There's a fairly easy way to put it together if you do it right. You can completely avoid that risk, but you're stuck with a corporation. So now, with a lower corporation tax rate, we're seeing that hurdle is a lot lower. We're going to see a lot more international real estate investment. We've got clients from Mexico, clients from East Asia that are investing in real estate in a big way, because now it makes a lot of sense to use a corporation. And so we're going to see, I think, a big increase in international business development in the United States, and Richardson is well poised to take advantage of that, thanks to the efforts of our concierge team and Mike Scull.
Gotcha.